Welcome to Yahoo Finance Live. I'm Akiko Fujita.
And I'm Brian Cheung. It's 11 a.m. here in New York City, and a lot of market movements after the big announcement from the Federal Reserve yesterday. We saw a rocket up in markets after the Federal Reserve's announcement at 2 p.m. Eastern. But of course, you can see right now red across the board. When you take a look at the Dow Jones down about 2.5%, that's over 800 points. NASDAQ Composite down about 4%, and the S&P 500 down almost 3%. What you're actually noticing is a massive reversal of the gains that we saw yesterday. I want to show you a two-day chart of what we've been seeing.
We're right back where we were yesterday leading into the press conference.
Still just barely in the green here, but again, we'll see how the market kind of bears out throughout the rest of this trading session. But, Akiko, you take a look, for example, at the VIX, look at the kind of ratchet up that we've seen just over the market session this morning. People getting concerned at close to a 29 handle. And of course, movement happening in the yield space as well, with the 10-year note on the longer end of the curve up about 13 basis points over the last 2 days. But of course, continuing this broad trend that we have seen over the last month in higher rates.
Well, and it's interesting when you were at the Fed yesterday during this press conference, but really seeing that huge acceleration on the back of Fed Chair Jay Powell's comments that he wasn't really considering a 75 basis point hike. I mean, that seemed to get the investors going yesterday at least. And it feels like there's a bit of a pullback today to say, wait a second, maybe it's not all good news.
No, certainly not. And I think that what the interpretation was after the kind of rocket up that we had seen in markets yesterday, let me again show you the two-day action. The increase that we had seen in markets after that was kind of an interpretation, well, you know what? The Federal Reserve isn't as hawkish as maybe people had expected going into that meeting. The Fed chairman saying, well, 75 basis points isn't on the table for the next two meetings. So, okay, well, maybe that means the Fed's not going to go out of control in terms of tightening the policy here. But maybe this reversal that we're seeing right now, at least one reading of this, again, quick reading, this has only been happening over the last hour and a half of trading, is that maybe we're doubting that the Fed is actually going to stick to its promise, at least as of yesterday, to only do 50 basis points in the next two meetings. Now, the one caveat of that, I would say, is when you do take a look at the bond yields, well, if it is indeed the case that they're doubting the Fed isn't going to be able to raise interest rates as slowly as they said yesterday, maybe you would have seen an even higher rip up in 10-year note yield today. So I'm not saying that it's insignificant to see only a 13 basis point move in trading today. But again, maybe should this be at 320 if it were indeed the case that people are saying, actually, there could be another 20 to 30 basis point increases from the Fed that maybe they weren't pricing in yesterday.
I mean, it sort of feels like the market's talked itself out of it, right? I mean,
the market talks itself into everything.
Well, yeah, but I mean, we were just, we got the statement yesterday. We got Jay Powell's comments yesterday. And here we are talking about, well, is it really just 50 basis points? I mean, the fact that we're having that question the day after, to me, just points to just how jittery the market is right now in this environment. And of course, when you think about the Fed's ability to control inflation, there's still a lot of things that are not in the Fed's control. And that's the big unknown.
Yeah, and that's exactly the issue here, is that the Fed's trying to essentially control demand. Take down demand, really, because that's the big driver of inflation, at least over the last year or so. The Fed chairman in the press conference answering a question that I posed about the mechanics of all of this. Higher interest rates are supposed to be throttling demand, either from business investment or also from consumption. Take a listen to what he said in response to that question.
What our tools do is that as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation.
So, Akiko, the commentary there kind of laying out a more plain English way, as plain English as I guess the Fed can do, into how these higher interest rates translate into consumer and business behavior. And the idea, either way you cut or slice it, is that it's going to take an economic hit. That's the consequence of these higher rates.
Well, the cost of borrowing is going to go up, bottom line. And it's interesting because I know you love to talk about the Fed, but the Fed isn't necessarily something that comes up in conversation. Everyday Americans aren't necessarily watching it. But the reason why it's so significant now is because what it means for everyday consumers. And we kind of pulled up some of the rates here. Bottom line, as Brian said, I mean, the Fed is trying to slow down spending to bring costs down. I mean, that's kind of the objective here. But if you look at everything from car loans You see where the rates are. You look at mortgage rates. I mean, the interest rates for a 30-year fixed, 5.11%. I mean, that is a significant hit if you're considering buying a house. You look at your monthly rate, your monthly mortgage payment. I mean, there's a lot of people who are now saying, well, is this the right time to buy? Is that going to lead to a pullback?
Yeah, and I think that, it's kind of thematically perfect that it's also earnings season. We're hearing a lot of companies talk about the economic concept of demand destruction. Now, what that means is the pushback that consumers are going to give companies where prices are at a certain point where I'm worried about inflation. I'm worried about geopolitical tensions right now. I'm not going to be able to take on these price increases anymore. Now, the good side of that is maybe it breaks the inflationary chain. Maybe it means that we've peaked. But it's also bad because what that really means is decreasing economic activity. Now, that is going to be the cost, as we played in that clip with Jay Powell, of these higher rates. And we're already seeing that not just in, people are like 50 basis points. What's 0.5% going to do on my bank deposits? It's not about the bank deposits. It's, again, about all these other types of longer-term interest rates that we're also seeing move up.
The big-ticket items.
The big-ticket items like buying a house, like renting a car or leasing a car, buying a car. So, I mean, these are all factors that are going to be coming into play. Fed officials are saying, look, it's doing what we're intending it to do. But look, until we get inflationary prints that are lower than the 1982 levels that we're seeing right now, it's not going to be enough.
Well, to me, as you know, I'm watching the housing market closely.
Yeah.
It is interesting to see where that tipping point is. And I guess you could argue that it depends on how heated the market is. We've heard about markets in Florida, for example, or Texas, these bidding wars that have been happening. If we're talking about a pullback as a result of rates going higher, is that, no longer having 40 offers on the table, but 20? And how significant is that cool down really? I mean, I will say just anecdotally, I had a conversation with my real estate agent the other day. Who in LA, by the way, who said...
A hot market.
Well, and also who has been very bullish on the housing market, who said, I don't think there is a point in waiting because I don't see a cool down. She came out and said, look, I'm starting to see the market soften. And that's just one anecdote, but that to me is just, it's a slight sign, but at least you've got consumers who are saying, maybe I don't need to make this purchase right now.
Right. And, again, home buying is going to be a very different, case-by-case scenario. People have their own idiosyncratic reasons for wanting to buy either their first or, in many cases, as the case with the wealthier during this pandemic. We know that wealth inequality has widened during this pandemic, buying a second or third or fourth home. But at the end of the day, what's interesting is that these are all going to be medium to long-term impacts on the propensity of Americans, but also businesses to be able to consume. When you consider that if you're getting locked into a 30-year mortgage, or even if you're not buying a house, if you're signing a new lease, 12 or 24-month lease for an apartment in New York City or anywhere else in the country where the rent is going up because the appreciation of the actual condo or the home is also going up, well, what does that do? If your wages are not going to keep up to pace with that, which in many cases is true, that's going to crowd out the ability of the money that you have left to buy furniture or to buy food or to buy clothing. So these are things that are not going to shake out in the next year. What's happening right now has the ability and the potential to impact consumption trends over the next decade, maybe.
Let's pick up on that point with our first guest for the hour. We've got U.S. Commerce Secretary